Can you be confident in the stock market? I did a post on this a few years ago. This is an updated post. All right. So first of all, which is true? The stock market is a gamble, a decent investment, but it may or may not make money for you. Or the stock market is a reliable long-term investment and it should be the core of your long-term investments. So which one of those is true? So what we're going to learn today is, how does the investment industry see risk? How do financial planners see risk that's different from the investment industry? What is the highest return asset class? Why does the stock market rise? What's the most reliable asset class after inflation? How large and how long are stock market declines? How long is long term when it says long term investing? What exactly is risk tolerance? It's a weird term. And how should long term investors invest? So first of all, let's talk about an effective investment outlook. So the investment industry tends to be very short-term focused, and they define risk as a market decline. Any market decline, that's the risk of your investments, because they go up and down. In financial planning, we are very much focused on the long term, which is your financial plan and achieving your life goals. So financial planning, the way we see investment risk is that you get a long-term return that's lower than what's in your financial plan. So for example, if your financial plan has, 8% per year built into it, we define risk as your long-term return is less than 8% a year. Now that's completely different from the investment industry. So, for the investment industry, they add, fixed income into your portfolio. It reduces your short-term market declines. So therefore they think it reduces risk. For us, we think, if you're adding fixed income into it, you have a lower chance of getting 8% or more as a long-term return. So that probably increases your risk of achieving your life goals. That's how we see it. So what you'll see a bit in this video is success in a long-term plan requires, number one, an equity focus. I think I explained that a bit more. For long-term investors, global focus for proper diversification, and you need an investment process that you will be confident in after it declines. Let's just compare, first of all, equities and fixed income. If you look at the returns, the last 90 years, what you see is, if you've invested in equities, whether it's US or Canada or international or global, $1,000 invested 90 years ago would be multiple millions today. So, however, if you're in fixed income, bonds or cash, you're talking 100,000 or so. It's just a dramatically lower amount. It's that compounding long-term growth that is missed. Oh, okay. And if you look at the returns per year, so fixed income, like between 5.7 for bonds, 4.2 for cash, but 3.5 of that is inflation. So the 2/3 of the growth of fixed income is inflation. It's not a lot above inflation as a long-term rate of return. And even while stocks, tend to be, close to triple inflation per year. And that's why you see, it's even much bigger after tax or after inflation, the outperformance there. So now, if you compare different asset classes, that was fixed income. But what about real estate? Because I know a lot of people think real estate has returns, like the stock market. But if you look at from 1974, these are the average house price in Toronto. The average price was about 75,000. Now it's a little over $1 million. But if you put that same 75,000 in the stock market, depending on whether it's US, Canada, or global, you would have somewhere between 7 and 18 million, not just over one. So the stock market has had dramatically higher returns than real estate. Even, just Toronto stock market compared to Toronto real estate, the Toronto stock market has had 6 times the growth of Toronto real estate. Now, people wonder, why does the stock market actually rise? Like, it keeps going up. Like, is this some bubble, or why does it keep going up? And the real underlying reason, there's a very solid reason underneath it. And it's because the profits of the companies in the stock market rise. So when you see a graph, you see how closely correlated they are over some time. And as these profits keep rising over time, companies are always looking ways to increase profits, lower their costs, get new products. They're always innovating, looking for new ways to raise their profits. And that's why the stock market goes up over time. Now, if you look at risk, the common term for it is standard deviation is how it's measured, in the investment industry and just abroad. Standard deviation is really a measure of uncertainty. And if you look long term, you should always look after inflation. So if you compare stocks to bonds to cash, the standard deviation, what you find is over 1 and 2 and 5 year returns, stocks are actually quite a bit more risky than bonds and cash. So they're less predictable over the short term and even medium term. But when you get to 20 years and more, most people are shocked by this, but stocks are actually more predictable than bonds and cash after inflation for periods of 20 years or more. So this is a study by Jeremy Siegel in the book Stocks for the Long Run. So you see the actual standard deviation after inflation for stocks is lower than bonds and cash. And this is why they're actually the most reliable. They're very reliable as a long-term investment, 20 plus years. So if you look at the range of the highest and lowest, this is a 200-year chart. The highest and lowest returns, these stocks can have, in a 1 year period, they can be 67% above inflation or 39% below inflation. Very wide range. But go out to 20 years, and you see that, the worst stocks have ever done is 1% above inflation. The best is 13. Well, meanwhile, bonds and cash have had 20, 30, even 40-year periods where they lost money after inflation. So you can be more confident in long-term growth with stocks than you can with bonds and cash. So now, if you look at the actual chart comparing the last 200 years, you see there's a trend line. The red line on the chart is the stocks trend line, and it's basically, 6.8 real, let's say 7% above inflation is that line. And if you look at it for the last 200 years, the stock market has pretty well always been very close to that line all the way along. But you can't draw a line like that with bonds, because bonds have had long periods where they lost money and again, and lost and gained. So if you look from 1940 to 1980, bonds actually lost half their value after 40 years. So you have in 1940, you have enough money to buy 2 cars, you put it in government bonds for 30 years, collect all your interest, and after 40 years, you can only buy 1 car. You've lost half your purchasing power 40 years later, a truly horrible investment. That could be your entire investing career. Right. So, and then meanwhile, it's because interest rates then went from, like 1 up to 20 in 1982. And from 82 down to 2020, interest rates came from 20 down to 1, and bonds, which helps bonds get a high return. So the bond returns weren't that much different the last 40 years compared to stocks. But the last 40 years of bonds are a weird time, unlike what you could ever expect again in bonds. You're never going to get 40 years where interest rates go down every year. So you can't look at the last 40 years as representative of bonds. But you see, if you see the long-term chart, if you try to draw a trend line on bonds, you'd end up with a few points way farther from the trend line than you do with stocks. So now that's the good news, that stocks are reliable as a long-term investment, 20, 25, 30 years or more, even after inflation. However, the bad news is they do decline, and these declines are not insignificant. So if you look at them, and this is the Canadian stock market, where you see 27, 38, 43%. These are big declines. They're not insignificant. So now, on average, these declines are 28% and last 9 months. So they're not that long. You fall 28%, you're down 9 months, and then the next bull market, and the average one is 130% for 4.5 years. So you're up 130%, then you drop 28, and 130%, and the declines tend to be fairly short. But you have to be able to live through them. So now, if you put them in a continuous chart, what you see in this chart, the yellow parts are the declines, and they feel significant. But in an exponential chart like this, you see they're actually just kind of blips in the long term, and if you just do nothing, it recovers. So based on history, the stock market has recovered from 88% of declines within 1 or 2 years, and it recovered from 100% of declines, and within 6 years or less. So now, here, if you look at 1 year chart of the stock market, it's all over the map. Now, most of the gains are up, and there's quite a few really big gains, but there's a reasonable number of down years and even some big ones. So the way you can see this, I get asked a lot at the beginning of each year. People say, "So what's going to happen in the stock market this year? What do you think?" As if I have some special knowledge or something. But really the best prediction is always just based on history. So based on history, these are the last 75 years, almost 40% of years is a gain over 20. So large gains are very common. Almost 4 out of 10 years are gains of 20. And also what they call normal returns, like a gain of between 0 and 20, that's about, again, almost 40% of the time. So less than half is a normal return. So you combine those two, a little over 75%. So let's say just over 3 out of 4 years are gains. Declines are small, what we call a correction, like let's say a drop of less than 20% is about just under 20% of the time, and large declines over 20%, about 4% of the time. So those are the odds. In any one year, you've got like a 75%, 3 out of 4 chance that it's going to go up, and a quarter that'll go down, but only about a 4 or 5% chance that it's going to be a major decline. So that's based on history, and that's usually the best way to make any sort of predictions from it. Now, the question is, how long do you have to stay invested to avoid large declines altogether? So you say you're okay with small declines, but you don't want large ones. So the answer to that is 7 years. Once you're in for 7 years, we've never had a large decline. Okay, there's been 6 times the last 150 years we've had a decline over 7 years, but it's always small, 1 or 2 or 3% a year. So, and how long do you have to be in to avoid declines altogether? And the answer is 15 years. So the last 150 years, all the calendar years have been positive. There was one in the 30s and early 40s where it was the Great Depression and the Second World War in the same 15-year period. But all the rest of them have been up. Now, these are calendar years. Okay, if you take every single month, then you have to go a little bit longer than 15 years. But these are the calendar years. And if you notice in this the chart, actually the last few years, the last while, the 15-year rate of return is actually lower than average. It's only around 5, and the average is more like 8 or 10. So now, how long do you have to be invested to be confident of strong gains? And the answer to that is 25 years. So if you look at the actual chart, what you see is the worst gain, like the gains in the modern stock market. You see a very definite divide. So from the 1800s up till about 1930, the gains were typically about between 5 and 8 over 25 years per year. Okay, and so from 1930 on, so years ending in mid 50s till now, the gains, the 25-year returns have been between 8 and 17. So okay, we're almost entirely between 8 and 15 kind of thing. So in fact, the worst 25-year period over the last 154 years was a gain of 4.9% a year, but that was way back in the 1800s. In the modern stock market, since the stock back then, it was mainly agricultural stocks and railroads and stuff, and it broadened into all, consumer stocks and all kinds of other products about 90 years ago. And since then, the worst calendar year return has been a gain of 8% per year. So that means $1,000 becomes, almost $7,000. So that is kind of the history. Based on history, if you're in for 25 years, the stock market has basically pretty well always been between 7 and 17 times higher after 25 years. And it's a gain you can be pretty confident in based on history that it should happen. So now part of what makes a difference here is it's important to diversify globally, or at least outside of Canada. So Canada is a tiny market, actually. It's only 3% of the world's stock market. And we're not a growth country. Like we don't have the high growth, hardly any of the high growth companies are here. In fact, 3/4 of our stock market is basically only 3 things. We call it rocks, trees, and banks, but it's basically financials, resources, and energy. And that's 3/4 of our market. So that's basically what it is. So the Canadian stock market isn't really a diversified portfolio. I don't think it should even be a core holding for anybody. So now when you go to global or US, like the global stock market is 3/4 US today. So you go to those areas, the companies are much bigger than in Canada. There's much more growth. The long-term returns have been a lot higher, much more diversified. So it's just a better way to invest either globally or in the US. So now, I showed you how reliable the stock market has been over long periods of time. Does that mean it's not risky? And the answer to that is not really true, because the risks are mainly behavioral. So, and the thing is that many investors will panic and sell when there's a large market crash, and that's the biggest risk, actually. When we actually look at clients and what kind of how should they be investing to try to achieve their financial goals, the big thing is, are they will they stay invested? Can they tolerate this? The ups and downs of the market? Will they get the actual returns? So the market has a good long-term rate of return, but if you don't stay in, you don't get that rate of return. So now most investors get far lower returns in the market, and basically what it is they buy investments that have performed well recently, and then after a decline, they panic and they sell it and they buy something else. That is, so basically they're buying high and selling low over and over again. That's the opposite of smart investing. And that's why most investors actually, believe it or not, most investors get lower rates of return than the investments they own. Now, you think it's easy to get the rate of return of the investment you own. You just do nothing. You just own it, and you hold it. But if you buy it high and sell it low, and then buy something else and then buy it back at high and sell it low, you're not getting the rate of return of the investments that you own. So a lot of people talk about risk tolerance. You go to an advisor or a bank and they give you a form that you fill out with a bunch of questions and it says this is what your risk tolerance is. But what actually is it? Does that really tell you what your risk tolerance is? And basically risk tolerance comes down to one thing, and it is the ability to do nothing when your investments go down. So the risk tolerance is your investments go down and you just stay invested, give it time, and based on history, it's eventually come back. If you can do that, then you've got a high risk tolerance. That's what it is. And the thing about it is a learned skill. I find a lot of people show as being conservative or moderate risk. And the main reason is they don't really know much about the stock market. So it's good to be able to look at. That's why I do talks like this. Is you can see. Let's look at what the history of it is. Okay, how strong are the long-term returns? How long do you have to be in to get a good return? When it does go down, how far? It doesn't go to zero. People think I'm going to lose all my money. Well, it doesn't go to zero. No, it falls 20 or 30 or 40%, possibly more. But that's the kind of decline, and then it comes back usually in a year or two. And so once you learn what the stock market does, then a lot of people can learn to have a much higher risk tolerance. Now, none of this is guaranteed, but we've got we had 200 years of stock market history. So it's a very good indicator of what is likely to happen. So now let's say your risk is not that high and you just wouldn't be able to stay in if your investments fall by 20% or more or something. So what should you do? There are three main methods to reduce risk. And there's more, but these are the main three. Now, one thing to know is anything that reduces risk essentially also reduces your return. So don't think it's a free lunch. I can just reduce my risk. It's going to reduce your long-term return as well, and usually quite significantly. So, but the three methods are: one is asset allocation, just hold some bonds and cash, or cash, either one, and it could be either separately, or you could have some balanced or asset allocation funds or something like that. That's one way. Another way is just focus on yield. So just focus on, stocks that pay dividends or things that pay interest, or you could buy an income fund where you have a variety of different kind of, income generating investments, yield generating investments. The third one is you can just buy conservative equities. So you still mostly equities, but you buy some low volatility, or you buy some stable, low growth stocks, and you're still in, but it's more conservative equities, and that tend to fluctuate less. So those are kind of things that you could do to reduce risk, but they would also reduce your return. And so I have a few other talks on my blog where I show a typical financial plan over, let's say you save for 30 years and then retire for 30 years. And, for people that go with an asset allocation, like a 60-40, 60% bonds, 40%, or 60% cash, equities, 40% bonds, they go to 60-40 portfolio. In most cases, you have to invest somewhere between a third and a half of your gross income to be able to retire with the same lifestyle that you have before, assuming your mortgage and stuff are paid off. So that's the issue. But for people that invest in equities, if they're 100% equities, generally, the plans that we see, basically people have to max their registered accounts, and that's usually roughly enough to be able to maintain their lifestyle. So it's quite reasonable. Like, you just save a fair amount to retire comfortably, but it's in the reasonable range if you're in equities. But as soon as you get into asset allocation or more conservative investments, often it's quite impossible to actually maintain your lifestyle after you retire. Your returns are just way too low, and you're going to have to retire on quite a lot less. So it's important to understand reducing risk also reduces your return. So can you be confident in the stock market? So first of all, yes, you can be confident in the stock market long term. Based on history, it's been reliable. Now, a suitable equity allocation for you, if you're not sure, like how much should you have in the stock market? So basically the answer is, what's the highest amount that you can have in equities being stock market type investments, where you will not get scared out of them in a market crash. So you look at how big of a crash could you tolerate and stay invested, and then have a portfolio that's targeting that as the worst case likely decline. Now, if you would panic and sell in a crash, or if your time period is shorter, then you should maybe look at one of those three methods to reduce risk. Now, if you're truly a long-term investor and you will stay invested through ups and downs, then you can basically ignore those three methods to reduce risk because they also reduce your return. You can be probably 100% equities is probably the best thing. And it's actually the most, it's very rewarding to actually achieve your retirement goal, retire comfortably and know that you can really enjoy life for the rest of your life, don't have to think about money. And to invest effectively makes that big difference. So how should long-term investors invest? First of all, you should buy investments where your return expectation is similar or higher than the market over time. That's after all fees and everything. That basically generally means you need an equity focus in the stock market. And for most, if you really are a long-term investor, 100% equities is generally the most effective for achieving your retirement goals. Invest globally for proper diversification. So buy basically global or US equities and have little or nothing in Canada. And then you need a process that you're going to be confident in when your investments are down. That's actually really important. So like I find a lot of people, my investments are down 10 or 20% and they got to quickly sell them. I said, well, that means you aren't confident in them. So you should have something that when it goes down, you're confident that it'll go up. So one way is just a broad index, the S&P 500 or the MSCI World Index. These, if you study them over history, when they've gone down, they basically come back with some time. And you're getting broad diversification and large liquid companies. So based on history, they have, you can generally be confident in these broad indexes, except for Canada, but you can be confident in them. So that's one way to do it. Another way, the way that we do it is you try to find the all-star, the really good investors, we call them all-star managers, to invest for you. So we work with a portfolio manager who has a process where they're trying to find these world's best investors. And because they have these really great investors, so when, it gives us confidence when the investments are down. The investments are down, but we got these really top investors that are doing whatever does or doesn't need to be done. They're doing it, and it just gives us more confidence to be able to stay invested. And you need that to be able to get the long-term return of your investments. So, all right, that's my talk today. So can you be confident in the stock market? So what we learned is, how does the investment industry see risk? How do financial planners see risk, which is different from the investment industry? What's the highest return asset class? How does the stock market, why does the stock market rise? What is the most reliable asset class after inflation? How large and how long are stock market declines? How long is long-term when people say long-term investing? What exactly is risk tolerance? And how should long-term investors invest? So, all right, thanks for listening. My name is Ed Rempel. My blog is Unconventional Wisdom. It's the #1 blog in Canada for a full-service financial planner. It's either edrempel.com or just unconventionalwisdom.ca because we're in Canada, don't have the .com. If you're looking for a free consultation, and interested in potentially talking to us, we offer a free 30-minute consultation, and it's just edrempel.com/talk. Easy to find. If you subscribe to my blog, podcast, and or YouTube, all that means is you get my new post out that comes out once a week, and you get it sent to your email. That's all it means. We don't market in any other ways. So podcast is edrempel.com/listen. YouTube is edrempel.com/watch. Thanks for listening, and we'll talk to you next week.